Hello, everyone. Welcome to our quarterly NEPC Market Outlook webinar. As you can see, a little bit different format today. We're trying something a little bit different. We moved into a new office space in June. We have beautiful branded wall behind us, and changing things up from the last 10 years of webinars. We're going to try something a little different in terms of how we're covering the market content, things that we're looking at. So we're going to spend 30 minutes or so. We're going to try to take questions throughout. So if you do have a question, feel free to put it in the question box at any time. And we're going to spend our time on really three main topics. We're going to spend a little time on the market outlook, looking at the election overview and what we're seeing in the election. We don't spend too much time on it because I think in many ways there's not much content to actually discuss there. And then a bit on China, and then also on the Fed and the outlook for the markets. So a little bit of a prologue to get us started as everyone signs on, and we'll kick it off with an intro, which I should have done at the beginning. I'm Phillip Nelson. I head the Asset Allocation team. My colleague, Appel, is joining us, and we're going to get started, and thank you for joining us. So with what's going on in the markets today, we think it's good to just have 2 minutes on kind of what's our kind of broad outlook that we're seeing in the marketplace today. And as we look at the capital markets from a top-down perspective, it's actually been fairly benign world the last 12 months, despite all the headlines that we're seeing. If you look back in prior years, it's always kind of big events that we were kind of throttled by. And in this year, we're kind of suffering through everything being not too bad. The economy is doing pretty well. The equity markets are doing quite well. Interest rates are doing fairly well. And the outlook for the economy and the outlook for the Fed is also holding a fairly optimistic path. So as we think about a couple of main items, first is looking at the Fed. We think what we're seeing from the Fed right now, the likelihood of interest rates decreasing by a significant amount over the next 12 months, you'll hear more from Jen on this, we think is less likely. And really the important items that we're going to be looking at, the market will be focusing on, is what's the outlook for the labor market? What are we seeing in terms of wage gains? What's the productivity levels for their overall market? And we're seeing a lot of sensitivity to every kind of weekly, monthly data print. And we encourage kind of taking a step back and really think about what are the most important things to think about when it comes to Fed policy. Not what's going to happen, in a couple of weeks in terms of the Fed meeting, but really how quickly do we get to 4%? Market thinks that might be somewhere near, early 2025 or even late 24. That's moved down around a bit. We think it's likely somewhere closer to into 2025 in terms of where we see that. So a much more kind of slow and methodical Fed, we think, is likely, despite some of the rhetoric we see in the marketplace today. Also, and you're going to again hear more from Jen on this, China's really at a critical crossroads today. China's a significant portion of emerging market assets, still struggling from some economic weakness, the real estate sector coming out of COVID and the muted recovery that we've seen. And, the analogy we'd use is looking back to the Eurozone crisis almost 10 years ago, there was a speech from the ECB head at the time, Mario Draghi, that said, we will do whatever it takes to support the ECB and the Eurozone. And that's what we're really waiting for from China. We have somewhat cryptic and somewhat lacking of detail in terms of stimulus commitments, and those really need to be fleshed out, or the market's going to really think about pulling back and look to a different trajectory, and it could be quite a volatile next couple of months for China. Election cycle coming up. I think often we spend more time talking about these type of events than their actual impact on the markets. They tend to be more tail risk oriented, but we clearly have heightened geopolitical risks. The election cycle only adds to that. So it increases the likelihood for surprises in global markets. And I think when we think about surprises, we often anchor to negative surprises. So I think it's more important to think about what are some of the positive surprises that we could see as well, that markets would take off and markets would rally as a result. And then kind of two items on the fixed income front. Some of this is a little bit more of an evergreen statement. When we think about safe haven fixed income, holding the liquidity and the conservative fixed income that we think all investors need in their portfolios. Really encourage, having that near your targets. After the last couple of years where fixed income markets have struggled a bit, with rising interest rates, we really encourage having your treasury positions, having your muni positions set in line with your benchmark targets. You really need that liquidity to both support private market commitments, but any spending needs that may come up. And also, as a reminder, fixed income is there to be that ballast when markets turn lower and become more stressed. And the correlations that we saw 2 years ago where equities and bonds, started moving away from their traditional relationship in terms of, fixed income being a risk offset, we're starting to return to a more normalized positioning for fixed income. We think it's a real benefit to maintain those targets in portfolios. And for those that have joined us over the last year or so, we spent a lot of time talking about high yield. In certain points of the last 2 years, we've thought high yield is quite attractive, both from a spread perspective and absolute yield perspective. And like all things, they move in a cycle, and we've really seen that kind of pull back, especially in the last kind of month or so. Yields are coming in, spreads are coming in, especially CCC spreads have come in quite a bit. And we really encourage folks to, use high yield as a portfolio liquidity source. Think of it as an opportunity to rebalance because it's done fairly well. And also for private credit, private market commitments, high yield can be a good source on that front. So what we thought we'd do is kind of kick things off with an election slide. We don't want to spend too much time here. We're less than 20 days away from the election. Jen and I have spent a lot of time, and many of you have heard from us talking about the election and what's the impact on U.S. markets. And a couple, I think, high-level takeaways that hopefully we can share is S&P 500 in the stock market has been a pretty good predictor of elections, especially 90 days before election day. So in times where, over the 90 days preceding the election, S&P is positive. Typically, the incumbent is won. Times where we've seen, S&P turn negative, we typically see the incumbent president not win re-election, or the party in power not win. Now, clearly, this year is a bit different. Things have changed quite a bit in terms of who we thought the candidates would be. But I think as we, think about what's the impact for markets in terms of this year's election cycle, and I think it's fair to say probably fairly muted. And a couple key things to bear in mind. One is markets tend to like divided government. So if we have one party in Congress, another party in the presidency, markets tend to like that dynamic. So to the extent that we do see a unified government, which would be a surprise when we look at, some of the underlying polling, that is the type of thing that maybe will sway markets either up or down in the preceding months. And just quick run through for those that maybe have purposely avoided, any political and election news until they get to the voting day in a couple weeks. But as we kind of look at polls today, I think it's fair to say, the election for president is largely a toss-up. The Senate race is looking more in line for Republicans to win, barring some surprises in Montana and Texas. And it's fair to say the House is pretty much a toss-up. And with that, it's hard to extrapolate too much of, what are the regulatory changes, what are some of the policy changes we might see. But we're focused on three main items here. The first is tax policy. And I think as you think about tax policy and the tax rates that are like the tax rates that will be expiring at the end of 2025, what is the leverage for either party to be able to negotiate some sort of change in tax policy? So to preserve kind of lower tax rates for 2026 and beyond likely means there has to be something on the revenue side that's negotiated through.
Yeah, and Phil, maybe if I could jump in there, I think the taxes piece is really interesting this time around because we have that complication of the Tax Cuts and Jobs Act kind of rolling off at the end of next year. So basically, no matter who wins, we're going to have some change, whether it's an extension of some of the existing provisions or some larger tax policy changes overall. But that point you made about the divided government, it really comes comes back to that. And I think oftentimes we sound like a broken record when we say that, but that really is the key piece here, because if there are slim majorities in Congress or a divided government overall, then having any big tax changes come through is going to be pretty hard. And I think it's possible that whatever happens at the end of next year with taxes could be pretty different than what we're hearing on the campaign trail, just given that dynamic. So something to keep in mind as we think of that, about things moving forward.
And especially as you think about tax policy and the implications for what does this mean for deficits, and how do deficits start to narrow in future years, likely means regardless of outcomes in early November, we will have fairly sizable deficits for the next couple of years. And with that, comes, the start of essentially the midterm elections start 20 days from now, and the election's 19 days from now, because 2026 is going to be a really important piece for Congress, because they're going to have to start to deal with where the real spending is, which really occurs in the entitlement side of the fence. The other items that we're thinking about, clearly tariffs and foreign policy. How does that flow through, to both global currencies and domestic manufacturers, and kind of an insourcing kind of push that you do see to some degree from both parties. And I think the last piece to kind of also think about is really the regulatory environment. What are we going to see from either administration in terms of the regulatory landscape? Small business confidence is fairly low today, and we look back to 2016, prior to Donald Trump's election, small business optimism and sentiment was fairly low. And within a couple of weeks post-election, the hopes for a less strong regulatory backdrop really fueled a small business resurgence. And it's something that when we think about, who can hold office and what the likely outcomes are, the outcome for small business is probably one of the more important ones, especially when we think about those are the majority provider of jobs in the United States. Overwhelmingly, small jobs provide something in the course of 70+% of jobs in the United States. I think the last piece on the elections, which I think we've learned over the course of anyone reviewing politics for the last 100 years, often what you hear on the campaign trail is often what you'll see in terms of policy being implemented. We often make flippant remarks about politicians of they'll say anything on the campaign trail, they're going to get reelected. But the reality is, when you hear policies from the candidates, that's likely what they're going to focus on when it comes to managing the government over the next 4 years. And so I think it's important to keep that in mind.
Maybe one last thing on this before we move on to some of the monetary policy backdrop, because I was looking at this chart that you were talking about with how equity markets are often good predictors of what happens in the election. So with the fact that we're sitting here with a Fed cutting cycle on our hands, just any thoughts on how that impacts this indicator?
Yeah, it's interesting, is what we've seen since the pandemic is most indicators haven't really worked. And we say indicators because we've corrected ourselves. We have a colleague that does this repeatedly. It's not a rule, it's an indicator. And when we've seen this with the inversion of the yield curve, typically has been a predictor of a recession. Now we can make the joke of 11 of the last 10 yield curve inversions have predicted a recession. But also other things, indicators we've had, the SOM rule, which looks at kind of trends and change in unemployment rate, hasn't quite shown, the potential for a recession coming in a reasonable time period. The economy is actually doing pretty good. And so it's a unique time where the economy is doing well, which should bode well for the incumbent president or incumbent party. But at the same time, a lot of underlying changes, a lot of turmoil below the scenes in the U.S. economy that, to some degree, the AI CapEx is hidden a little bit in terms of the cap cycle we've seen from artificial intelligence.
Yeah, thanks. I think that's helpful. And part of the reason for my question is that I want to get into what's happening with the monetary policy backdrop today. Obviously, we just had a 50 basis point rate cut by the Fed, which you can see a little bit on this chart here. But I think what's arguably more interesting is the fact that we have market expectations, consumer expectations that haven't budged away from the fact that rates are going to move lower in pretty quick order. So I think this is really fascinating to see over the course of the year, even as we've gotten some of that more resilient data and kind of a stubbornly resilient US economy, markets are still saying rates are going to move lower. And I think about that in a couple different ways, but part of this, I think, is just the Fed is kind of making this their own problem, because you think about the end of last year, Powell came out with all those more dovish comments than expected, which caused the market to say 6 rate cuts were going to happen in 2024. Then recently, with that other jumbo size rate cut, markets started to extrapolate that's going to be the pace and magnitude that we're going to get moving forward, similar to what we've seen leading up to some recessions historically, which I think is pretty disconnected from that more resilient economic backdrop that you're talking about. But this is just so strange when you think about this rate cut obsession relative to the economic reality today. And what I think is important, and we talk about this a lot, is really now that we have a rate cut under our belts, why is the Fed actually cutting rates? And there are a couple reasons you could think through. One being that we do have some economic weakness, which I don't think you've heard that really from us today, but that's typically what you see in that path before a recession. Or is it the fact that the economy is still doing pretty well, but inflation's not quite as high? Maybe we're seeing a little bit of softness in certain pockets, and just rates don't have to be quite as restrictive as they once were. So those are some of the considerations that we have, which I think are quite different than what you're seeing being priced into the market today.
Yeah, because you have a real push-pull on this of, in some ways, if the economy's good and things are going well and there's plenty of job growth and really limited kind of job losses, why does the Fed need to cut?
Right.
It's historically that would be the pattern, almost kind of do nothing, do no harm.
Yeah.
But at the same time, you look at where we are with kind of real interest rates. If year-over-year inflation's close to 2.5%, we're sitting at a 5% Fed funds, 250 basis points of real interest rates. That's fairly restrictive when you look back through history. And so the market, to some degree, is almost on a kind of knife's edge in terms of, is the economy good? Or can we start forecasting that, the economy is starting to turn south and job losses are coming? And this is something that we've talked a lot about, is the job losses necessary for a recession are significant and so far away from the projections we're seeing. We need something in the order of 2 to 3 million jobs lost over the next 9 months to be able to start talking about a recession. And we're still consistently seeing 150, 200,000, jobs gained at a month-to-month basis.
Yep.
And you see this, quite often, Jen, just in terms of thinking about how does the Fed expectations, maybe the much maligned dot plot, but also the market's expectations, what the Fed would do, how does that compare relative to kind of our outlook and some of the projections that flow through our capital market assumptions?
Yeah, and so I think for anyone that's listened into some of these webinars over the past year, you've probably heard a healthy dose of skepticism from us about this 6 rate cut path, or whatever it is today in particular. So I would say we are overall biased to the upside a little bit relative to what the market's pricing in. And it does come back to a lot of the points you mentioned around the labor market, and also just some of the continued strength we see in the economy that we just don't think the Fed has to cut quite as deep, quite as quickly, unless something really goes wrong in the near term.
Yep. And maybe just as a quick reminder for folks, if you do have questions, feel free to send them into the question box. We have a screen here on our right, so we can see the questions pop up, and we'll try to kind of cover them as we're going through the session. And maybe for you, Jen, as we think about data points and things that the Fed are focused on, obviously jobs, inflation is a critical input, but what are some of the, beyond the obvious economic data prints, what are some things that folks can take away of, buried in page 6 of the journal, or 9 clicks through the websites for any economic or any news source. What are some data prints that we're focused on that we encourage folks to kind of just be mindful of?
Yeah, I think there is a standard suite of data that probably everyone's looking at this point. The one thing that we've been talking about a lot recently, especially with some of the jobs reports that have come out, is looking at the real wage growth figure from the BLS that's published. So it was, again, probably a little bit more robust than folks were expecting. And I think at the offset, you kind of talked about that relative to productivity rates. That's a really important relationship for thinking about where the Fed is actually going to go from here. Because if wage growth is high and productivity is high, then the Fed can continue on this cutting path. But if wage growth is high, productivity is not there, then we could see rates staying a little bit higher than what's priced in today.
And this is, it's hard at times, especially kind of in our roles. There's a couple of big topics that folks like to talk about, AI being one of them. And it's not an easy connection to draw Fed policy relative to the AI trends, but this is one where it's really clear, where if we see clear productivity gains in the economy, which we actually saw a fairly sizable amount this last year, then that gives the Fed a lot more capability to be able to kind of grow the economy. Real growth is higher, real wages are higher. You have a little bit of almost a Goldilocks moment like you saw in the mid-90s in terms of what the economy looked like.
Yep. So I want to kind of switch gears here. I know we've spent much of the year, much of this webinar talking about US policy, but we finally have some noteworthy news coming out of China. So a little bit of a tough transition here, but basically, I think we all know the story that post-COVID, China's economy has really struggled. And from a policy standpoint, I think investors have really just been looking for more. There's been this kind of steady drip of incremental policy announcements over the last few years that really haven't moved the needle for markets. But then right at the end of the quarter, we did get this slew of announcements that you can see on our slide that was much more of a fire hose. So the reaction function from markets was so strong in response, since this is basically what they've been waiting for over the last couple of years. And I know we were sharing all these anecdotes about new account openings being at record highs, or some glitches on stock market exchanges that were just really a reflection of all this kind of excitement in markets. And I think it makes sense to some extent. You see all of these announcements related to the property sector, related to interest rates, that you're trying to have some top-down policy that will address some issues. So the market got really excited about that. But there is a note of pause in there, since the economic reality is still somewhat difficult. There are a lot of top-down issues that these policy announcements just won't be able to address. And I won't go through all of these. I'm sure we probably have more we could add to the list since we published this slide. But what I think is interesting is that a couple of these announcements, whether it's lowering rates marginally or some relaxation on the property sector, those were things that we actually got over the last couple of years with that incremental stimulus. But now we're starting to see maybe a wider scope, maybe a larger magnitude on some of those, that the government is trying to actually make a change for the economy and for confidence. But I don't know that this is going to be enough to get us there, to your comparison to the Draghi moment in the Eurozone.
And historically, we've seen when EM does well, it actually tends to do well when the Fed is kicking off an easing cycle.
Yep.
So there's actually starting to be a fair amount of healthy tailwinds to support China, support EM. But we're in a really critical moment. And I think there's a lot of investors who are really focused, and this is long-term investors who are really looking at China over the next 2 months, and going to be making some big decisions in terms of their policy targets of, is this worth it or not? Are they willing to do what it takes to kind of push the market to a better spot?
Yeah, and China has historically just been a very divisive topic for investors. But what I think has happened since this announcement too, it seems like that's become even more exaggerated, where you're having some folks that were pro-China for a long time saying now valuations are there. The backdrop is more friendly, so I want to buy everywhere, everything that I can, versus the other side that says I don't want to touch that with a 10-foot pole, essentially. So it really has changed that, but I think that makes it so difficult sometimes as investors to say, what should I do? And especially as you look to some of the volatility that's happened in markets as of late, it's really hard, I think, to be taking some tactical bets when the market's moving just as it is. And you can see this is basically something that Chinese investors have had to deal with for as long as we've been able to invest. So hopefully, and this has been true historically, that investors are going to be compensated for this volatility. So that's what we're looking for.
Yeah, and I think one of the things as we see market rallies, when China does rally, it's not in 5 or 10% moves. It is 50% plus. Now, it's clearly not a prediction. In some ways, it would be a very nice result. But when markets do move in that space, you get a doubling down effect of both good news that's not priced in, is now discounted. And on top of that, you start to see flows start coming back into the market, which is a very traditional emerging market style return profile. After what's been, as you said, tough few years to say the least.
Yep. And as I alluded to with some of the stimulus announcements, so I think these top-down initiatives have been helpful, obviously, for sentiment from the market perspective, but we still are seeing this pretty big gap between what the market's pricing in and all of the hopes around stimulus moving forward versus what the economy is telling us. And I was trying to think of what's the best way to talk about all these top-down issues, and I think this crisis of confidence is really at the core of everything. It's all the property price deterioration that we've seen, the growth impact, rising unemployment, and you can just add it in, and this is the result. And this poses so many issues, I think, for the economy moving forward, because if confidence is low, consumer spending just isn't going to be there. So there's this negative feedback loop for deflation and how that flows through to the economy overall. So I think this is probably at the top of the government's mind when they're thinking about what should we do moving forward. And fiscal stimulus is one kind of direct way that you can try to address this versus some of the announcements that we've already seen.
Yeah, and you know, all politics is domestic, and there's still a political backdrop in China that one has to be mindful of, especially the political leaders there, as they're thinking about how do they improve the confidence, as you mentioned, how do you forestall job losses? You know, there's a deflationary bias that's starting to flow through into China unless something is done. And can domestic politics there handle a 10-year decade, 15-year decade of deflation like we saw in Japan? And I think, you know, just from self-preservation starts to kick in, you know, political leaders there will start to realize this, and they may not want to do QE, but if you want to keep your job, you may have to do a QE type program. So the hopes is the next month or so, we'll probably see a lot of news out of China.
Yeah.
So we wanted to wrap up with just kind of a brief overview, what our high-level positioning views are. A couple items that kind of want to highlight. You know, these are views that we share with all our clients. We share internally. They might not be, perfect for each individual circumstance for our clients, but kind of from a macro top-down perspective, we think, you know, flows into how we're thinking about the world and how we're thinking about portfolios and tilting them over time. So a couple points to hit on. Active management, we think, is a really useful tool, especially in today's market. When you have more volatile inflation prints, you have more volatile economic growth, when you're moving off interest rates that are no longer zero like we saw in the last 15 years, you have more variance in the world. And that's great for active management. That's great for stock pickers. So as we think about that, especially in a global context, really focused on global equity managers. And as we look at kind of the bench and the roster that our investment team here at NEPC has developed, really bullish on that list. And, we use them considerably in our OCIO platforms. I think many of you have heard from us in terms of the quality of those managers, and really think it's a good place in portfolios today, especially considering all of the kind of uncertainties we've highlighted over the last 20, 30 minutes or so. Second is just thinking about equity targets. I think being mindful of equity targets, and what we mean by that is, don't be too underweight equities, but at the same time, if you find yourself a bit overweight, it's a good opportunity to pull back, especially in markets where it kind of outperformed expectations. Within the US, where we've seen really strong trends, especially at the beginning of the year around AI and the Mag 7 space, still looking at kind of exposures that have value factors, we think is a really healthy place to be to help complement that large cap exposure, especially if we move into a market environment where the yield curve is a little more steep, the economy is still doing well, inflation's normalized, economic growth is normalized. It's almost a benefit to the rest of the S&P 500. So think of those 493 other names, I think would do pretty well in that type of world. Jen talked a lot about China. And I think fair to say volatility is certainty. And so that being said, really have to be committed to that space to be able to enjoy the benefits should we see a strong upside for EM. It's not a market you can kind of move in and out of. It's not a market where, from an asset allocation perspective, you can make tactical calls very easily. So would really encourage, stick to your targets. It's volatile, but it's volatile for a reason, and it's within a normalized level of vol. And these are the boom and bust cycles that we typically see for asset classes that we've seen for all assets over the last 100+ years. And then lastly, we see a favorable environment for real assets, and say that in context of two main factors. Most of the globe and kind of the market is discounting a bit of a bias to economic weakness, which is a headwind for what's called commodities in the real asset space. But also when we think about, should we see a geopolitical event or a kind of surprise to the markets, they typically transmit through combination of currencies and public real assets. And so to the extent you have targets, you have exposure to that space, encourage kind of maintaining that. And depending on kind of inflation sensitivity, something to think about of, does it have a place in portfolios? So last little bit of a commercial before maybe take a couple questions is a little bit of a dangerous offering. We debated a lot about dates, but the last kind of 12 years or so, we've done a post-election webinar. We're going to do it Friday, November 8th. We didn't want to do it on Wednesday, the day after the election. Not certain that we would have anything to discuss. Waiting a week or so longer seems like too long, so we're going to go with November 8th to talk about the election and kind of share what are some early insights that we're seeing. On top of that, should we have no news, the Fed will be meeting on November 7th, so at least you can hear us improvise and talk about the Fed. Should we see kind of no news quite yet for the post-election webinar, but encourage you all to kind of check your inboxes. That'll be coming soon, and join us then for a little bit of a political roundtable discussion. So with that, why don't we hit a couple questions? And Jen, if you want to kick us off, does some of the recent inflation data prints, in your mind, have any impact on the Fed's decision making? So we're 2 weeks out from a Fed meeting. Does what happens the next 2 weeks essentially matter from the Fed's perspective? The market seems to think it does.
Yeah, I don't think so. And I know I think for most of this conversation, we've been saying we disagree with some of the things that the market's pricing in. The market's been really reactive to every single data point that's come out, probably more so than it has historically. And I think this past CPI print, for example, was one that was a little bit hotter than expected. But when you looked beneath the surface, it was shelter, which has been the usual suspect over the last couple of years. And there were a couple other things that popped up with food or used car prices and things, but nothing that seemed out of the ordinary from that standpoint. So I don't think it changes their trajectory, but the one thing maybe I'd put an egg out there for is that we have been looking a little bit more at oil prices, just since there is that geopolitical risk backdrop. So energy prices are kind of the wild card for inflation moving forward. So that's maybe something I'd be looking for.
Yeah, I think kind of another interesting piece here is, we don't spend a lot of time internally, us and the rest of the team, talking about what Fed funds are currently.
Yep.
The real important piece, and it's harder for maybe folks at home to be able to see it, is what's the expectation for Fed funds 18 months from now? And 18 months from now, markets saying it's below 4%. Do we see that in the next 12 months? Do we see that in the next 2 months? And those are the type of ranges that we're seeing for the market as kind of trying to discount a path. And so to say, don't worry too much about the next Fed meeting. Really think about what does it mean in terms of the path over multiple meetings that the market's looking to digest. Maybe you mentioned oil a bit, but maybe we can dig a little bit deeper into kind of oil markets. Are there any events that you're concerned about, or any kind of areas that you're concerned about in the impact of oil? Maybe adding in kind of natural gas as well, which is something we maybe covered in more detail a couple of years ago. Yep. In terms of kind of supply issues.
Yeah, I think when we talk about the real assets complex and commodities, most specifically, the biggest concern at the moment is around geopolitical risk. And that's something that by nature is just unpredictable. But when you see headlines about potential strikes on certain energy infrastructure, that is concerning just from a supply standpoint. So I think you've seen the market reacting to that a little bit as of late. But I'd say that the important step too is to kind of take a step back and think about what else is happening at the same time that we have this geopolitical risk, because we do have all those problems in China that we were talking about, and that's a big piece of the global demand story for oil in particular. And also the production story for the world is very different than it used to be. Yeah. So even if we do get some supply coming offline, there's a potential that it could maybe not be as impactful as what we've seen in the past.
Yeah, and in some ways, oil at current levels is almost a little bit of a stimulus for many countries because it's at such cheap levels. You get something closer to above $100 a barrel, starts to become a little bit of a tightening. So think about also kind of gas prices for consumers. As gas prices tend to rise, cuts into consumer spending a bit, although somewhat less than it used to relative to 20, 30 years ago. Last question is, thinking about our thoughts on the dollar and what we're seeing on that front. So today, the European Central Bank announced another 25 basis point rate cut. So that's 3 cuts for this year. They're at 3.25 in terms of their rate. And you'll see Canada and the UK probably follow suit over the next several months. So in some ways, as you see global growth maybe look a little bit better, and you see some easing flowing through the world, that should be a reason that the dollar starts to weaken a little bit. As in some ways, the dollar serves as a risk-off currency, but also at the same time, if the Fed moves more slowly than the rest of the world, that probably is a little bit of pressure on the dollar on the upside. So the dollar becomes a little bit of a carry trade where you can earn, 4.5%, 4% relative to, what might be, something, less than 3% overseas. Last, maybe kind of one more question here that came in, thoughts on tips and kind of what we're seeing in that space. Maybe, from a duration bias, I don't think we have too much of one, but, are supportive of kind of looking at the full curve, both kind of 5, 7, 10-year tips in terms of investments, but maybe kind of talk briefly about our outlook for tips.
Yeah, so we've been suggesting to our clients to add strategic policy targets to tips. So I would read that as not necessarily a tactical view, although there have been times where tips have looked more attractive or less throughout the course of the last year. But mostly this is a reflection of the normalized real rate environment. So for a long time, I think tips were just more challenging to invest in, especially when we had negative real rates. And that whole dynamic has changed as of late. So that's really kind of the core thesis there.
Great. So I think with that, we will wrap. Thank you all. And if you do have feedback on this new format and prefer to not see us as opposed to just hearing us as we go through slides, feel free to share that with your consultants or reach out to us. The slides here will be posted on the NEPC website, and there'll be a deeper set of slides with more detail covering a broader aspect of the markets. And again, thank you for joining us. Look forward to seeing you all Friday after the election for our election webinar. And we'll again be hosting this next quarter as we kick off the new year. So thank you, everybody.
Thank you.